Welcome to this lecture on mortgages. Most students and some practitioners are really wary of the law of mortgages, but it's important to get to grips with it. The idea in this lecture is to give you an overview of the law of mortgages. We've only got one lecture on mortgages, so I'll be leaving you to read the more straightforward things for yourself in your textbooks. Mortgages are really important for residential, domestic, commercial and economic reasons, and most of us will be involved in mortgage arrangements at some time in our personal lives. If you've got any ambition of going into property work, commercial property, banking law, etc., then the law of mortgages is also going to be very important for you professionally. But a word of warning before I start. In 1904, Lord Macnaghten said, "No one, by the light of nature, ever understood an English mortgage of real estate." And even though the law was radically reformed in the property legislation in 1925, that statement remains largely true. Some of the law of mortgages simply defies common sense. In this lecture, I'm going to do a few things. First of all, I'm going to explain to you or remind you, should I say, of the way that mortgages are created and protected. And then I'm going to explain to you the protections that are afforded to borrowers. The lender-borrower relationship is a relationship that cannot be left to market forces, and there are some very stringent protections that are afforded to the borrower. I'll also go through with you the rights and duties that the lender has in a mortgage arrangement. Let's start off with some definitions. The mortgagor is the borrower, the person who receives the cash, promises to pay back the money, grants the security, grants the mortgage. The mortgagee is the lender, the body that receives the promise to pay, it receives the security. Please get the terminology the right way round. In everyday speech, we are completely wrong and misleading when we talk about the bank giving us a mortgage. The bank doesn't give us a mortgage. The bank hopefully gives us some money, and we grant the bank a mortgage over the property as security. The term mortgage or charge is interchangeable, but I'll start by going through an old-fashioned definition of a mortgage. Santley and Wild in 1899 says that a mortgage is a conveyance of land, so a transfer of land, as security for the payment of debt or discharge of another obligation. In more modern terms, it's a loan of cash which is secured by the mortgagee being granted rights over the property as security. This notion of land being transferred by the borrower to the lender, as it was in Santley and Wild, no longer applies. The borrower remains the owner of the property but grants a very substantial proprietary right in favour of the lender as security for the money. This notion of security is really important because the lender will be in a privileged position if the borrower goes bankrupt or if the borrower cannot pay the loan back. The lender has a claim to the property over which the security was granted, and this takes precedence over any other creditors. So how are you going to remember which way round the mortgagor and the mortgagee go? Well, I've made up some silly rhymes in my time. The mortgagee is not me, it's the building society is one way, or it's me that is the mortgagor, it's what I go to work for, or something like that. One of my more sensible colleagues says that the word mortgagor has got two O's in it, as has borrower. The word mortgagee has got two E's in it, as has lender. That's very sensible and a good way of remembering it. I don't really care which way you remember it, just do it. So this final definition of a mortgage or charge. A charge is a term that's often used by practitioners instead of a mortgage. There is a technical difference between the two, but for your purposes and in practice, the terms are used interchangeably. We might ask, is the land charged? Meaning, is it mortgaged? Mortgages are listed in the charges register of titles at the Land Registry, but mortgages, remember, aren't the only things that appear in the charges register. Other burdens on the land, like covenants and easements, appear there too. So what are the formalities? Well, we're going to start off in familiar territory. A mortgage is a powerful right in land. It's capable of being a legal interest in land, and we know this because it's on the list in section 1.2 of the LPA 1925. But in order to be legal, it must be properly created. Mortgages can also be equitable, and I've put that on the slide too. I'll come back to that in a moment. So a reminder then of how we create legal mortgages. Well, they're capable of being legal interests, and we know from what it says in section 52 of the LPA that all legal estates and interests in land must be created by deed. And section 1 of the LPMPA says that to be a deed, a document must be clear on its face that it's intended to be a deed, it must be signed by the mortgagor and witnessed properly, and it must be delivered. So to create a legal mortgage, you've got to use a deed. And sections 85, 86 and 87 of the LPA also elaborate on that by saying that you can create a legal mortgage of a freehold or leasehold by creating a deed that says you're creating a charge by way of legal mortgage. For our purposes, and almost always in practice, a mortgage is created by deed. It's the simplest, it's the most obvious way to create a mortgage, and it's the only way of creating a legal mortgage for the purposes of this course. And once you've created your deed, then to finish the acquisition process, you must register the mortgage to enable it to take effect as a legal mortgage. It's then enforceable against anyone who subsequently owns the mortgaged land. And if the mortgage is granted over previously unregistered land, then section 4 says that that creation of a mortgage over unregistered land kickstarts the first registration process. So hopefully you'll remember that from earlier in the course. Hopefully you'll also remember that if you don't create your legal mortgage properly, then you may end up with an equitable mortgage. Not necessarily, but you may do. The most alarming thing about all of this, and the thing that laymen don't realise, right in land. So if somebody buys a freehold that is subject to a mortgage, if the seller doesn't pay off that mortgage when the sale goes through, then the buyer will take the land subject to the outstanding mortgage. The message for practitioners, therefore, is that when you're acting for people who are buying land, make sure that you've got undertakings to discharge outstanding mortgages before the purchase goes ahead. What about equitable mortgages then? Well, equitable mortgages can be created in a couple of ways. First of all, the method that I mentioned earlier on, where you intend to create a legal mortgage, but you fail to do so because you don't follow the correct formalities. But there's still a high degree of formality required, which there never used to be. Equitable mortgages used to be created simply by handing over the title deeds as security for a loan. Nothing was written down. In my earlier days in practice, I can remember farmers parking their tractors outside our office. It was a very rural practice, and going into the bank next door with a carrier bag full of documents, coming out empty-handed, and what they were doing was creating an equitable mortgage over part of the farm temporarily, maybe to pay a VAT bill or something like that. But you can't do that now. In order to be an equitable mortgage, there has to be some formality, and it needs to comply with section 2 of the LPMPA. It's got to be in writing all terms and signed by both parties. You can't create an equitable mortgage simply by giving somebody the title deeds anymore. You've got to do more, and that's what it says in the United Bank of Kuwait case. Equity won't any longer recognise the deposit of deeds as an equitable mortgage. So where is all this leading to? Well, if you're trying to create a legal mortgage, but you fail to do so, it could still be interpreted as an equitable mortgage if what you've done amounts to a contract to create a legal mortgage. In other words, if the failed document complies with Section 2 of the LPMPA, the court will interpret it as a contract to create a legal mortgage which can be specifically enforced. The second way equitable mortgages can arise are mortgages of equitable interests. These are very common, very important in commercial transactions. They do exist in residential transactions, but not so much. They're very useful for short-term commercial borrowing, where the parties want to avoid the formalities and the cost of creating a full legal mortgage with all that that entails. They use a brief memorandum and deposit of deeds. If you're a borrower and you've only got an equitable interest in land, then you can only create an equitable mortgage even if you use a deed. You can't grant what you haven't got, so you can't grant a legal mortgage if you've only got an equitable interest. The requirements for making a disposition of an equitable interest are set out in 53(1)(c) of the LPA in writing and signed by the grantor, but generally speaking an equitable mortgage is usually created in accordance with Section 2 of the LPMPA. In order to protect an equitable mortgage, then a notice must be entered under the Charges Register of the burden title under Section 32 of the Land Registration Act. In unregistered land, it's a C3 land charge against the borrower's name. Hopefully all that will be revision, and even though it might not be crystal clear, hopefully it will ring some sort of muffled bell at the back of your mind. So it's reasonably straightforward to create a legal or equitable mortgage. And now I want to go on to the new stuff, which is looking at the rights of the borrower and the rights of the lender. I said a few minutes ago that the lender-borrower relationship is monitored by the courts, by statute and case law. It's not a relationship that is left completely to market forces. So what rights does the borrower have in the land which he or she has mortgaged? There are basically two rights. The first right is what we call the contractual right to redeem. And the word redeem means paying back all of the money and getting back the land unencumbered by the mortgage. So if you redeem the mortgage, you give to the lender all of the money that's outstanding under the terms of the loan, and they cancel their proprietary right in the land, and you as the borrower now hold the property unencumbered by that proprietary right. The lender gives up all of its rights over the property because the borrower has paid all that he owes. A borrower will have promised to repay the capital and interest of the loan, typically over a long period. 20 to 25 years is quite common in residential mortgages. These days, some lenders are offering loan repayment terms of about 30 to 35 years. But mortgages can be outstanding for as little as a year. There's no hard and fast rule. So the term of the loan is initially the time over which the borrower has agreed to pay back the loan. But the borrower doesn't have to keep the mortgage for that length of time. You know, if you take out a 25-year loan to buy your first property, you don't have to keep that first property and that loan for 25 years. You can sell the property and pay it back early. But what's the technical rule on all this? Well, in the mortgage deed itself, there'll be a date set out, which is the date on which the borrower is to repay. This is known as the legal redemption date, and these days it's normally about 1 to 6 months from the date on which the mortgage was granted, and it's known as the borrower's contractual right to redeem. Bizarrely, it exists only for 24 hours, and it gives the borrower the right to repay the loan on that day. If he doesn't repay on that day, then the loan cannot be repaid until the end of the term. Now, as you can imagine, that's not much use to the borrower because it's a very limited right. Very few borrowers will be in a position to pay back the whole of their mortgage loan within 6 months to take advantage of the right. So the legal contractual right to redeem is of really limited value because it arises too soon. And this is one of the aspects of mortgages law that I said defies common sense at the beginning of the lecture. I think that this particular rule has its roots in the pre-1926 law when the borrower transferred the property to the lender subject to a proviso for redemption. The mortgage was repayable on the legal redemption date, and if it was repaid then, the mortgagor got the property back again. If it wasn't repaid on that date, and sometimes lenders went off abroad and made it hard for the borrower to repay, then the legal position was tough. The mortgagor lost the property, the lender could keep it, even if it was worth much more than the debt. So equity intervened, it stepped in, and it developed extra rights for the borrower to soften the impact of these very harsh legal rules. And it's the intervention of equity here and the rules that equity gives the borrower which are the most important and which give the borrower the most protection. So although you need to understand what the contractual right to redeem is, these days it isn't of much practical importance because it's not much use to the borrower. The borrower needs more than simply a 24-hour window, 6 months from the start of the mortgage term, to be able to repay the money. So what has equity done? Well, equity has introduced the equity of redemption, and it's an umbrella term for a collection of all sorts of other rights which a borrower has, including the first one on the slide, an equitable right to redeem. Please beware of confusing these similar terms. Equity of redemption is the term that encompasses all of the rights and protections that the borrower has, whereas the equitable right to redeem is simply one of those rights. Equity's developed this series of rules that can be summarised in this phrase, equity of redemption, because equity is protecting the borrower, the little man in the transaction, and it protects the borrower from all sorts of exploitation. At law, the borrower owns the land that's burdened with the legal mortgage, but in equity, the borrower also owns this bundle of rights, this bundle of protections that we call the equity of redemption. The equity of redemption is roughly valued at the value of the property without the loan less the outstanding debt. And that's where we get our phrase, the equity we have in our houses. When people talk about having equity in their houses, they're talking about what the market value is less the outstanding debt. In other words, the value that is actually theirs. And if they're talking about negative equity, that's a term that means that there is more outstanding on the mortgage than the property is actually worth. The basic rule on this equity of redemption is that there must be no clog on the equity of redemption. And what that means is that the courts will take steps to protect a borrower against treatment which affects the borrower's rights in the property. Now, all this sounds very theoretical and difficult, but actually it's not too bad when you come to look at the detail. The first thing that equity does to protect the borrower is to recognise that in addition to the legal right to redeem, which I mentioned a few minutes ago, there's also an equitable right to redeem, which is much more generous than the legal contractual right. Remember, the legal or contractual right arises 6 months or so after the mortgage starts, and it lasts for 24 hours. And if the borrower doesn't repay back the loan in that time, then they can't do it till the very end of the term. Equity adds much more generous provisions to that right. Equity's view is that it doesn't care what the contractual or legal right to redeem is. Equity thinks that a borrower should be able to redeem a mortgage at any time after the legal date for redemption, and it's very flexible about it. If the borrower can pay back the capital and interest, they should be able to pay it back at any time after the legal date for redemption has passed until the very end of the mortgage term. So here on my example slide, we've got a mortgage deed that was entered into on the 18th of October 2017. In that mortgage deed, it's clearly stated that the legal date for redemption of the mortgage is the 18th of April. And remember, that right to redeem on that date lasts for 24 hours. The equitable right to redeem will arise as soon as the legal right to redeem has lapsed. So it will arise on the 19th of April and it will last till the end of the term. I've got an awful feeling that that should be 2018. Let me just go back. Oh, it should be. I'm really sorry. I really don't want to go back and start recording this lecture again. So can you just make your notes that that should be the 19th of April 2018 in the example, and I will change it on the slides that are going on the VLE. My apologies. Try to be professional and we're just hopeless. Right, so that's the equitable right to redeem. The second way that equity protects a borrower is by developing rules against clauses in mortgage deeds which prevent the borrower from redeeming or postpone redemption. And it's all a question of whether the right to redeem is rendered valueless or illusory. And that's a question of degree in each case. So I've got a couple of examples because I think examples make it more real than me trying to explain. The first one is options to purchase. You can't have a clause in a mortgage which says that the lender has an option to purchase the property. And that's because if the lender exercises that option, it means that the property goes to the lender and the borrower is prevented from repaying the loan and getting the property back unencumbered. The cases on this are Samuel and Jarrah, Reeve and Lyle, and Warnborough and Garmite. Samuel and Jarrah sets out the usual rule that options to purchase which are granted to lenders in mortgage deeds will be void. However, an option might be valid if it's given by a subsequent independent transaction, as it was in Reeve and Lyle. So as long as the lender can show that the option it was granted was completely independent of the mortgage and separate to it, it may well stand. In the Warnborough case, the court must look at the substance of the transaction. Here, a mortgage and the option had been granted on the same day, between the same parties, but the option was genuinely part of a separate sale and purchase deal. It wasn't part of the mortgage transaction, and therefore it was allowed to stand. So that's options as an example of preventing or postponing redemption. Another example is clauses which push back the legal date for redemption, because if the legal date for redemption is pushed back, so is the equitable right to redeem. Remember that the equitable right to redeem doesn't kick in until after the legal date for redemption has passed. Now, lenders don't want you to pay money back early because they're only going to earn interest if you keep the loan outstanding for as long as possible. So one of the tricks that lenders got up to in the past and still get up to today to make the loan last as long as possible is to push back the legal date for redemption. And that keeps the borrower locked into the mortgage until the legal date for redemption has passed, because the equitable right doesn't kick in until the following day. Now, the court's approach is different in domestic and commercial mortgages. In domestic mortgages, courts tend to be more generous to borrowers. In the commercial context, it might be okay to include a clause postponing the redemption as long as the right remains real. So what we're looking for in deciding whether the courts are going to uphold clauses postponing redemption is, first of all, if it's a residential or commercial property, and secondly, is it a real right to redeem? Has it been pushed back so far that really it doesn't exist anymore? And I'll explain what I mean by looking at two contrasting cases. In Knightsbridge Estates and Burn, this was the commercial mortgage of a freehold property. It was a pub, and the mortgage deed said that the legal date for redemption was 40 years after the start of the mortgage term. So the equitable right to redeem didn't kick in until 40 years and 1 day. The borrower wanted to redeem early, and it asked the court to declare that the clause was invalid to enable it to pay back the loan early, but the court said no. This was a commercial transaction. It was an arm's length business transaction. The borrower knew exactly what it was getting into. They entered the transaction of their own free will, and at the end of the 40 years they would get back exactly what they put in, unencumbered freehold land. The court also noted that there was something in it for the borrower. In return for the 40-year postponement of redemption, the borrower was getting a very low interest rate. So it might have been inconvenient, it might have been unusual, but it wasn't unconscionable, it wasn't oppressive, and the clause was allowed to stand. Compare that with Fairclough and Swan breweries. This was another case about a mortgage of a pub. This time it was a leasehold property and it was mortgaged to the brewery. At the time that the mortgage was granted, the lease of the pub only had 17 years to run. The legal date for redemption set out in the mortgage deed was that the loan couldn't be redeemed until 6 weeks before the end of the lease. The borrower wanted to repay earlier and went to court asking for the clause postponing redemption to be struck out. And the court did so. The court said that if they upheld this clause, then the borrower wouldn't get back what they'd put in. They'd have a lease with 6 weeks to run, which would be worth considerably less than what they put in, which was a lease with 17 years to run. So the court allowed the borrower to redeem early, even though there was a clause preventing it, because otherwise, they said, the right to redeem would be an illusion. So that's another aspect of the equity of redemption. Equity wants to protect the borrower's right to redeem the loan, and it's not keen on clauses which postpone that right. In an arm's length commercial transaction it's okay, but in a domestic transaction it may be very different. The third aspect of the equity of redemption is the court's view on lenders taking collateral advantages. If you'll pardon the expression, equity's not keen on lenders having a little bit on the side, because equity sees a mortgage simply as security for a loan and nothing more. If the borrower can't repay, the lender can sell the property and recover what's outstanding, but the mortgage shouldn't be an opportunity for a lender to gain other collateral advantages, collateral to the main point of the mortgage, which is security for a loan. In domestic transactions, collateral advantages are particularly frowned upon. Think of it this way. If you took a loan from Tesco's Bank and granted Tesco's Bank a mortgage over your property, and Tesco said, that's okay, but you've got to shop here for your food throughout the mortgage term, you'd be very surprised if the court would enforce that obligation. And it's a bit of a silly example, but it illustrates the point. The bank is not allowed to get something more for itself than it's entitled to, which is capital and interest repayments. More realistically, lenders might try to insist that borrowers take out specific insurance so that they get the commission on the insurance, or they might charge an admin fee. You know, all these sorts of things that borrowers have to pay to lenders. Lots of them, which are in mortgage transactions now, could be challenged as collateral advantages, but the lenders so far get away with it. So collateral advantages are not allowed in residential transactions, but to be struck out, of course, the borrower's got to challenge them, and lots of borrowers don't realise that they can. In a commercial context, they might be allowed. Often, big breweries will lend money to people to enable them to buy pubs, or oil companies will lend money to people to enable them to buy petrol stations. But in return, they want the borrower not only to grant them a mortgage over the property, they also want the borrower to buy all their products from them. So beer, wine and spirits from the brewery, petrol and all that other stuff from the oil company. These things are called solace ties, S-O-L-U-S, solace ties, and courts will accept and enforce them in certain circumstances. Now, I'm only talking about land law principles here. I'm not looking at competition law. I'm not looking at EU law. I'm only telling you what the score is with land law. Courts will allow these collateral advantages as long as the advantage to the lender stops when the mortgage is repaid. That's what Noakes and Rice said. In this particular case, a pub tenant entered into a mortgage arrangement and agreed only to sell the lender's wines and spirits. That applied for the remainder of the 26-year lease, even after the mortgage was repaid. The court wouldn't allow this. It said it devalued the equity of redemption because what had been mortgaged in the first place was a free house. When the mortgage was repaid, because the tie was still existing, the pub was a tied house, and that was very different from the free house that had been mortgaged. But the court did say, and acknowledged in Biggs and Hoddinott, that provided that the collateral advantage stops within the mortgage term, then it will be allowed, or may be allowed. It all depends on the lender, the borrower having legal advice, knowing what they're doing, and etc. So the collateral advantage must not be unconscionable. It mustn't be oppressive. It mustn't involve improper pressure or unfair dealing. So you're looking to see what the collateral advantage is. Does it stop within the mortgage term? If it doesn't, is it genuinely independent? Because if it's genuinely independent, it will be allowed. but it mustn't ever be unconscionable. So a lot to think about, but actually it's a lot more straightforward than it initially seems. The fourth thing that the courts of equity will look at when protecting a borrower is terms which are unconscionable. There are actually two sets of regulations for this sort of term. First of all, the courts of equity have a power to strike down terms which are oppressive, but there's also statutory regulation too. So I'm going to start with the case law. So courts have the power to strike down individual terms or alter individual terms of mortgage deals if they believe them to be oppressive. And by oppressive, I mean oppressive. I don't just mean unfair or unreasonable. And there are two cases that are really useful to compare and contrast. And it's important to know the facts of these cases. In one case, Cityland and Dabra, the terms were changed. In Multiservice and Marden, the terms stood. And we need to get to grips with why they were changed in one case, why they were left in another. What reason did the court give? What did the court take into account in making its decision? It's not just about how high the interest rate was. It's not just about the numbers. It's more about the circumstances in which the term was imposed. Was the lender taking advantage of the borrower in a morally reprehensible way to get a lovely high interest rate for itself? So you can read the details of these cases for yourselves, but I'll just give you an outline. Cityland and Dabra then. In this particular case, the borrower had been a tenant of the lender for about 11 years, and his lease was coming to an end, and the landlord stroke lender made it clear that they weren't going to renew his lease. So he was under some pressure, because otherwise he would be homeless. He was under some pressure to agree to their suggestion that he bought the property from them. Now, he didn't have a great credit record, and when his landlord said, "We'll lend you the money," and the landlord became a lender, the borrower signed up to the mortgage deal. And he signed himself up to some horrific terms. First of all, the interest rate was 19%. And if you consider at the time of recording this lecture, the interest rate, the base interest rate is 0.25%, you'll see that 19% was extremely high. Having said that, interest rates haven't always been as low as they are at the moment. When I took my loan for my house way back in the 1980s, the interest rate was 8%, and it shot up to 16% within a few months of us buying the property, and that had a huge impact on the level of our mortgage payments. Nevertheless, 19% is extremely high. In addition, the borrower had agreed that if he defaulted, so if he was late in paying any payment, then he would pay a premium of 57%. So an extra 57% of the amount that was borrowed was loaded on to the mortgage debt. That meant that if you ironed out the terms, he was paying something like 38% by way of interest. Needless to say, the court didn't allow this. It struck it down as an unconscionable term, but not because the numbers were high. It was because the lender had abused their bargaining position. They'd taken advantage of the rather trusting, rather naive borrower who hadn't had legal advice. They weren't able to justify why they had charged such high rates. It wasn't justified in terms of the potential loss to the lender. It wasn't justified in terms of risk. It was a pure abuse of bargaining position, taking advantage of somebody who otherwise would be homeless and were rather desperate to get a roof over their heads. In Multiservice Bookbinding and Marden, again the mortgage deed incorporated some very oppressive terms. There was a postponement of the legal date for redemption for 10 years. There was an effective interest rate of about 35% because the payments of the loan were to be made in Swiss francs, and something odd happened to the exchange rate between the pound and the Swiss franc, and it ended up being a very expensive loan. When the borrower went to court to have some of these terms struck down, the court refused. And it said that's because there's equal bargaining power. The borrower wasn't in a desperate position. They borrowed the money to expand their business. They didn't have to do that. They went into it with their eyes open. They had legal advice. They thought that the mortgage deal was a good deal, paying in Swiss francs. They'd taken a risk on the exchange rate staying the same. The exchange rate hadn't stayed the same, and you can't then come whinging to the court to get things put right for you. They took a risk and it came unstuck. They also said that the lender, who was Mr. Marden, was a private individual who had invested his life savings in lending to Multiservice, and he was entitled to make a profit. So what those cases illustrate is that the courts are going to be very watchful for terms that are imposed on borrowers by an abuse of the bargaining power of the lender. They can't be justified in terms of the losses that the lender risks. It's all about trying to get away with as much as you can. So I would recommend that you have a look at those two cases in some detail and be comfortable as to what they're all about. On to statutory regulation of terms of mortgages. The Financial Conduct Authority, since the Financial Services Act 2012, now regulates all mortgages. It has this statutory regime for being able to look at and alter and amend mortgage terms under that legislation. Previously, there was a mishmash of all sorts of legislation. There was the Financial Services and Markets Act 2000, there are various Consumer Credits Acts, and there are the unfair terms in consumer credit regulations. So lots and lots of statutory regulation. Now those have all gone now, and it's the Financial Conduct Authority that is regulating, but nevertheless, some cases that were decided under the old regime are still relevant now. The Financial Conduct Authority applies affordability tests, and it's got various other factors that it takes into account. The borrower's ability to repay, and making sure that the borrower is safeguarded from being taken advantage of. The statutory regime only came into force in April 2014, so there's not much case law on it yet. But basically, under the previous regime, the Consumer Credit Act 2006 was on the lookout for unfair relationships between lender and borrower. The Consumer Credit Act 1974 was looking for an extortionate credit bargain. The consumer credit regulations were looking for an absence of good faith. Basically what the courts were on the alert for was lenders who were trying to impose terms which were morally reprehensible. The terms had to be extreme. It wasn't enough for the borrower to say that the bargain was simply commercially unreasonable or to the lender's advantage. All of the terms are to the lender's advantage. The lender must be taking advantage in an immoral way for equity to unravel the transaction. And I've just got a few cases here to give you an idea of what is and is not allowed. In Falco Finance, there was a term in the mortgage that even if the borrower was late in paying by 1 day, the rate of interest that was charged increased by 5% for the entire term. This was struck down as an unfair penalty and as an unfair relationship under the previous legislation. In Davies and Direct Loans, though, the high interest rate was justified because the borrower was self-employed and had a poor credit history, and the lender was justified in charging a high interest rate because it was taking a risk in lending in the first place. And in Paragon and Nash, again, a high interest rate was justified because the lender itself was suffering financial difficulties. Lenders borrow the money that they lend on the international money markets, and Paragon Finance was having to pay more for the money that it was borrowing, and in turn should I say, it was passing on that higher cost to its borrowers, and that was deemed to be okay. The last factor I want to think about when looking after borrowers is undue influence. Here we're talking about a situation where a loan has been secured on a property, but the loan isn't necessarily for everyone's benefit. I'm going to be sort of politically incorrect here and just talk in very traditional terms about how these cases arose. Typically, we're talking about a situation where husband and wife have granted a mortgage over their home to secure a loan that's been granted to husband for his business. So the husband, for example, might have been running his own business and he needs some money to buy some capital, some sort of machinery. He might need to pay a VAT bill. There are all sorts of reasons why he might need some extra money. The business itself hasn't got enough assets on which to secure the loan, and the bank wants some security, so they look to the family home. And this happens to all sorts of businesses, and it enables the wheels of commerce to turn. The house might be in joint names, or it might be in the husband's name only, with the wife having some sort of beneficial interest behind an implied trust. In this situation, the wife has got to sign the mortgage document, and the lender must ensure that it took reasonable steps to make sure that the wife is fully informed and that she knows exactly what she's getting into and has had the implications of the transaction explained to her in a meaningful way. If not, then the lender's mortgage ranks second behind the wife's rights as owners, and that means that the mortgage effectively can't be enforced. So what the bank needs to do is to consider the people who might claim that they've been unduly influenced to sign a mortgage document, and they may therefore seek to make it void. The theory is that somebody shouldn't be held to a transaction if they've been induced to enter it by somebody who has abused their trust and confidence. And the easiest way to explain this is to look at the case of Barclays Bank and O'Brien from 1994. Typical situation, Mr. O'Brien ran a business, he needed some money, the bank agreed to lend him money provided that there could be a mortgage granted over the matrimonial home in favour of the bank as security. That is deemed to be a loan that's not for the benefit of all borrowers. It's directly for Mr. O'Brien's benefit, but not for Mrs. O'Brien's benefit. We might think that she will indirectly benefit because of the income that the business generates, but strictly speaking, the loan is not for her direct benefit. Mr. O'Brien misrepresented the situation to his wife. He said that she had to sign the document, that the loan was simply for a short term of about 3 weeks, and it was for a small amount of money, £60,000. He was actually telling lies. The loan was for a much longer period, and it was for £154,000. When Mrs. O'Brien nipped into the bank official just got her to sign the mortgage. He didn't explain the effect of it. He didn't tell her about the lender's rights. He didn't tell her to take legal advice before she signed it. The husband's business failed, and the bank tried to repossess the property. It tried to enforce its proprietary rights. And Mrs. O'Brien successfully argued in the House of Lords that the mortgage was unenforceable against her on the basis of misrepresentation and undue influence. She said that there's a relationship of trust and confidence between husband and wife. She did what her husband said. She accepted his judgment and influence. Sounds really old-fashioned, doesn't it, girls? He had misrepresented the situation to her, and he'd influenced her to enter into the mortgage. Well, that's fair enough, but why should that mean that the bank can't repossess? It's him who's told the lies, not the bank. Well, Mrs. O'Brien argued that the bank had constructive notice of what he'd done. The bank should have realised that she'd only enter into the transaction because he wanted her to, and the bank should also have realised that if it didn't explain the transaction to her, Mr. O'Brien might not tell her the absolute truth. And he certainly wouldn't have been able to give her the full spiel on her legal rights. So the bank should have explained it to her and made sure that she entered the arrangement of her own free will. The point about undue influence is that the onus is on the lender to ensure that anyone who's got an interest in the property has got independent legal advice before entering the mortgage, so that they go in with their eyes open. They can make a proper consent knowing what the lender can do if things go wrong. Otherwise, they can argue undue influence to get out of the security. A contrasting case to O'Brien and heard on the same day is CIBC and Pitt. Here, the husband and wife mortgaged their home to pay for a new holiday home. That was ostensibly for their joint benefit, because the new holiday home was going to be in their joint names, etc., and they were both going to use it. The husband used the money with the wife's knowledge but not her approval to speculate on the stock market. He, of course, lost it. The court said that the wife couldn't argue undue influence because there was nothing to put the bank on notice that there's anything to be concerned about. The loan was in their joint names, the house was in their joint names, the benefit was for them jointly, so there was nothing to alert the fact to the bank that they should have been doing something more. So she failed to have the mortgage set aside for undue influence. The Ettridge case from 2001, which you can read for yourselves, is very similar by way of facts, but it tells us exactly what a spouse or a co-owner has to be advised in order to make sure that they can't argue undue influence. The list of factors is quite long, but essentially the co-owner must be advised of the effect of the document, the seriousness of the risk, what the lender can do if everything goes wrong, and the fact that the borrower can say no, they don't have to do this. The court says that there's a presumption of undue influence every time a transaction calls for an explanation. So if you hear about somebody guaranteeing the loan of another by creating a mortgage over their home, and you ask the question, why on earth would you do that? That's a potential situation where there could be some undue influence. So it's not limited to husbands and wives or partners who live together. It will apply in any non-commercial case where somebody is putting up their property as security for the debts of somebody else. So parents and children, grandparents and grandchildren, friends, anybody where it's not obvious why they're doing this and it's not for their joint benefit. The onus is on the lender to show that a borrower has been properly advised, and that onus is very high. And of course lenders don't rely on themselves to do it, they shove the onus onto their solicitors. So the reasonable steps then are set out in Ettridge, and you can look at that for yourselves. So that concludes the section of the lecture where I'm talking about the protections that are afforded to borrowers. Now we're going to go on to the rights of the lender. The lender has got a few rights, but there are two main ones that we need to be talking about, and that's possession and sale. When things go wrong in a mortgage situation, a lender always has the option to sue the borrower in contract for the mortgage debt. The mortgage creates a contractual obligation between the lender and the borrower, but it also creates something much more than a contract. It creates a proprietary right. Now, once somebody has got into a pickle with their mortgage payments, the contractual right to sue for a debt is pretty worthless, and the lender wants something a little more robust. In the last resort, the lender wants to repossess the land and sell it. If there's a shortfall after it's been sold, the lender can still sue the borrower for any outstanding money in contract. So handing in the keys is not going to solve a problem. We don't really need to say anything more about the contractual right to sue for a debt. I really want to go on about the rights that the lender has to enforce their proprietary rights. So the right to possess is one of the most important. If things go wrong, the lender needs to be able to realise the security quickly and convert it into cash. So they need to be able to possess the property, get an estate agent in to do photographs, get people into view, and then exercise their right to sell. So possession is usually an essential preliminary step before a sale to let surveyors, agents and buyers in. And this right is acknowledged by statute in section 95(4) of the LPA, but it's also acknowledged in case law in Formaids and Dudley Marshall Properties. Lord Harman said, it wasn't Lord Harman then, the lender has the right to possess the property before the ink is dry on the mortgage deed. So the lender has the right to possess mortgaged property immediately the mortgage deed is signed. Now, obviously, the lender doesn't want to do that. In fact, most mortgage deeds, most residential mortgage deeds, will contain a term that the lender won't exercise its power to possess as long as the borrower pays his instalments every month. So the right will be postponed if payments are made. So we needn't worry about the bank representative wandering into our houses. But technically speaking, there is an immediate right to possess, and it's a very powerful right. And it is a right. It doesn't have to be prefaced with a court order. It's a right that can be exercised at any time. However, in residential property, statute imposes some restrictions on the right of possession, but in any event, it's a good idea for the lender to get an order for possession, and that's to protect the lender from criminal proceedings. The Criminal Law Act 1977 makes it a criminal offence to use or threaten violence to gain entry to premises. So self-help by a lender to take possession is very risky if there's a chance of anybody at all being in occupation of the premises. So generally speaking, you would advise a lender to apply to the court for an order for possession. if you do apply to the court for an order for possession, then it's very likely that the court will postpone that order, at least in the first instance. The bad news for the lender is that the court has discretion to postpone an order of possession under Section 36 of the Administration of Justice Act 1970. It applies to residential or part residential property only. So if a lender applies to the court for an order to possess residential property, the court immediately has jurisdiction to postpone that possession at its discretion if it thinks that the borrower will be able to pay the outstanding arrears within a reasonable time. So it's not the whole sum, it's the arrears that have got to be paid within the reasonable time, and that's what Section 8 on the slide there says. Reasonable time has been examined in various cases, but Cheltenham and Gloucester and Norgan takes it as its starting point the outstanding term of the mortgage, and as long as the borrower can repay the arrears by the end of the mortgage term, then the court will suspend or postpone possession. Now, that means that if there's a 30-year term and arrears arise after 2 years, and the lender applies for an order for possession, the court will postpone possession if it thinks that the borrower can catch up with the arrears in the remaining 28 years of the term. It's almost inevitable that a court is going to say that the borrower has a chance to do that. So in the initial stages of possession proceedings, it's highly unlikely that a court would ever make an outright order for possession straight away of a residential property. It would always postpone in the first instance. But a court can only suspend possession where there has actually been an application for an order. In Repegalach, I think that's how you say it, the borrower wasn't living in the property. They were doing it up. It was being renovated. The lender therefore didn't seek an order for possession, but went straight into self-help and took possession. When the borrower applied to the court for an order to suspend possession, the court couldn't do anything to help. Because there hadn't been an order in the first place, the order couldn't be suspended. And that seems to me to be nonsensical. Section 36 can only be used where the lender brings an action, so the borrower would always and should always be advised not to give up possession voluntarily. The second important right for the lender is the power of sale, and again I mean a right to sell where the sale can take place without a court order. There's two things you need to distinguish here. First of all, the power of sale arising, and secondly, the power of sale becoming exercisable. Section 101 of the LPA gives a power of sale impliedly, but most mortgage deeds contained very detailed powers of sale as to when they arise, when they're exercisable, etc. So in practice, in the real world, the first place you would look would be at the mortgage deed, but we're going to start with statute because of the nature of this course. If you've got to draft a mortgage deed and you forget to put your power of sale in expressly, you can fall back on this implied power. Statute says that the power arises when the mortgage is made by deed and the legal redemption date has passed. Payne and Cardiff says that if the loan is repayable by instalments, the power will arise as soon as one instalment of capital is due. In the Horsham case, it was argued that Section 101 is contrary to Article 1 of the ECHR, the right to property, that claim failed because there are so many protections built into the legislation on rights to sell. So that's when the power arises, basically when the capital has not been paid. It's exercisable when one of the 3 factors in section 103 is present. First of all, if the lender has served notice to the borrower to repay the whole loan and 3 months have passed. Secondly, if there's some interest in arrears for 2 months at least. Thirdly, if there's been a breach of another mortgage term. So, for example, breach of covenant to insure or to repair. If the building is falling down through lack of repair, the lender might take the view that it's going to possess and sell to minimise its losses. Once one of those factors is present, then the lender can go ahead and sell. But the lender does have duties when selling about the method of sale, the price, and when it can sell. And those duties are very, very straightforward, and I'm going to leave them to you to look up in your textbooks. The lender could also appoint a receiver, somebody to manage the sale on behalf of the lender, or if the mortgage property is subject to leases in favour of tenants, the receiver might manage the properties, or if the mortgaged property is business premises, then the receiver might go in and help to run the business to try and get things back on track. Amazingly, the receiver is deemed to be the agent of the borrower under the statute, so any complaint about the receiver not doing his job properly can't be levelled at the lender. And finally, a very old-fashioned right of the mortgagor, the mortgagee, I'm getting my own terminology the wrong way around, is foreclosure. It's a process by which the court issues an order that vests the legal estate in the lender, free from any interest of the borrower. So the lender will take the property free of the debt, no matter how much or how little is outstanding compared to the value of the property. It's a really cumbersome process. It's hardly used now because the court tends to use its discretion to order sale instead of foreclosure. There doesn't really seem to be any advantage to the lender in trying to use that right. That's the rights of the lender under a legal mortgage. Just a word about equitable mortgages. In Re White Rose Cottage, Lord Denning said that an equitable mortgage can, in certain circumstances, confer a power of sale, but it's generally thought that none of the rights of possession or sale can happen as of right with an equitable mortgage. It's safer to go to court to ask for an order. It's also worth noticing that none of the implied provisions apply to equitable mortgages. So if you're drafting an equitable mortgage, you must include a power of possession and a power of sale expressly. The court won't imply one for you. And of course, as I've just said, the enforceability of an equitable mortgage does seem to be discretionary and not as of right, so the lender would be well advised to go to court for an order for possession and sale rather than blundering in by itself.